The chill of a bear market can feel like a sudden, isolating fog, obscuring every familiar landmark of certainty. It's a time when the ground beneath our financial feet seems to shift, and the narratives we once trusted begin to crack. Many feel a deep unease, watching their hard-earned progress erode, perhaps remembering past seasons of loss, of plans derailed, of trust broken. This is not merely about numbers on a screen. It touches the very core of our aspirations, our sense of security, and the future we've meticulously planned for ourselves and our loved ones. The conventional wisdom, often loud and insistent during these times, frequently proves to be a flimsy shelter, leaving us vulnerable to the tempest of fear. Is your comfort in market trends truly a fortress, or a mirage that dissolves when the winds turn cold? We often find ourselves caught in a psychological vortex when the market descends. The urge to panic, to flee, or to simply shut our eyes and hope it passes is a natural human response to perceived threat. This is where Benjamin Graham, the sagacious architect of value investing, offered a profound mirror to our own nature. He observed that the investor's chief problem, and even his worst enemy, is likely to be himself. His words cut through the noise, reminding us that the deepest battle is often fought not against market forces, but within the chambers of our own minds, against biases that amplify losses and blind us to genuine opportunity. The market, in its short-term dance, is a voting machine, swayed by emotion and fleeting sentiment. But in the long run, it is a weighing machine, slowly but surely assessing true value. The challenge lies in discerning this fundamental truth amidst the clamor. This journey is about moving beyond passive hope and the paralysis of fear. It's about cultivating an inner stillness, a discerning eye that sees through the market's emotional theatrics to its underlying mechanisms. We're not simply reacting to the market's mood swings. We're seeking to understand its pulse, its hidden truths. We are here to uncover the data-driven frameworks that empower truly informed investors to shift from a defensive crouch to a strategic offensive, even when the world around them whispers despair. Don't just invest, understand the why behind every decision, especially when the path ahead seems shrouded in doubt. Together, we will explore the often overlooked strategies that transform market downturns from periods of dread into crucibles for forging enduring wealth and resilience. The silent dread of watching years of dedicated effort, of patient saving and intelligent investing begin to evaporate can feel like a cold hand gripping the heart. It's a profound frustration when the dogma of time in the market beats timing the market rings hollow, as a long-term strategy delivers only short-term pain, leaving us feeling powerless. This experience can shatter the expectation that market downturns are merely temporary blips to be endured. The truth, revealed in the decurrence of data, is that markets operate in distinct regimes, each demanding a nuanced, dynamic approach, challenging the very notion of a set-it-and-forget-it mentality. We are often taught that diversification and dollar-cost averaging are infallible shields. Yet, in the crucible of a true bear market, when correlations among assets often spike to 1, these strategies can prove distressingly porous. The conventional wisdom, while valuable in certain seasons, sometimes overlooks the systemic risks that emerge when fear becomes the dominant currency. The data tells a different story, one where the market is not always a gentle river, but at times a tempestuous sea, requiring the skilled hand of a navigator, not just a passenger. To discern these shifts, a data-driven approach offers a path to active risk management. Imagine a 3-step quantitative technique. First, monitoring momentum indicators to gauge the market's underlying thrust, its true direction beyond daily fluctuations. Second, observing volatility signals, the market's erratic heartbeat, which often foreshadows deeper shifts. And third, analyzing economic leading indicators, the whispers from the economic future that can signal broader trends. This triangulation allows us to identify true market regime changes, enabling a strategic reallocation towards defensive assets or even a temporary embrace of cash. It transforms passive exposure into a conscious, empowered act of protection. Consider the market as a vast battlefield. The passive investor often stands exposed, hoping the storm passes, vulnerable to every gust of panic. But the data-driven strategist, much like a seasoned general, doesn't merely hope. They redeploy their forces, fortify their positions, and even seek strategic advances when the enemy, often market panic itself, is at its weakest and most irrational. This is the essence of moving from reactive fear to proactive, intelligent action. We are uncovering the hidden truths behind wealth accumulation. Even when the market tries to obscure them with a veil of despair, the market's chill can create a quiet tension, a dissonance between the insistent mantra of always be invested and the deep, intuitive need for safety. This often leads to overwhelm, a paralysis around holding significant cash, as if it were a weakness. Many feel annoying anxiety, fearing missed opportunities, even as their portfolios shrink. It's a struggle to reconcile conventional wisdom with the protective instinct that whispers, hold back. The common distortion often paints cash drag as an undeniable negative. Yet, in the fierce winds of a bear market, the true cost of illiquidity in rapidly falling assets far outweighs the perceived opportunity cost of holding cash. When assets plummet, being forced to sell to meet obligations or stem losses is the real drag. In these moments, cash transforms from a mere holding into dry powder, a strategic reserve that grants power and flexibility. Herein lies a counterintuitive truth. The long-term impact of even small cash reserves in a bear market isn't just about capital preservation. It's about the asymmetric power it grants. This liquidity allows the discerning investor to acquire quality assets at fire sale prices, fundamentally altering future compounding potential, while others are forced sellers, gripped by fear or necessity. The prepared investor becomes a discerning bear, planting seeds of future prosperity in fertile, undervalued ground. This perspective echoes the wisdom of Benjamin Graham and David L. Dodd's security analysis where the margin of safety is paramount. We often apply this to asset valuation, but it extends just as critically to portfolio liquidity. Holding a margin of safety in cash allows for calm, rational decisions when the market is in turmoil, when others are in distress, and when panic forces them to become sellers. It's a mental healing model, knowing you possess the means to act deliberately rather than react impulsively. Imagine cash in a bear market as a deep, clear well in the midst of a severe drought. Others scramble, desperate for a few drops, their fields parched. But the prepared investor, having nurtured this well, possesses the means not only to survive but to cultivate new growth when the rains eventually return. This transforms scarcity into a profound strategic advantage, allowing us to challenge the consensus and find our edge. There's a deep, unsettling feeling when the market descends into a frenzy, indiscriminately punishing sound companies alongside the weak. It can wound one's very sense of fairness, leaving a lingering question. Why does rationality seem to vanish, leaving us feeling outmaneuvered by an invisible, irrational force? Many are told that market timing is a fool's errand, an impossible feat, an excuse for inaction. Yet, the data whispers a different truth, revealing distinct periods of extreme investor capitulation. These moments, often born of widespread despair, reliably mark critical inflection points for the truly patient, value-oriented bear. The story of Jesse Livermore, a titan of early market speculation, wasn't just about trading. It was about the profound importance of independent thought, of seeing past the emotional exhaustion that grips the crowd just before a reversal. He understood that market bottoms aren't unpredictable chaos. They're often heralded by a psychological surrender. To navigate this, we turn to a four-step value investing technique, a meticulous process to discern genuine intrinsic value from the market's noise during extreme downturns. First, discounted cash flow, or DCF, to project future earnings, giving us a vision beyond the immediate storm. Second, asset-based valuation, understanding the tangible worth beneath the market price. Third, a rigorous assessment of management quality, for a ship is only as strong as its captain. And fourth, forensic accounting, a deep dive to verify the true strength and integrity of the balance sheet, ensuring no hidden cracks lie beneath the surface. This is how we move beyond the headlines, understanding what's really driving the market. Consider the market during a panic as a raging torrent, sweeping most downstream in its powerful current. The contrarian, however, is guided by a steadfast compass of intrinsic value and an anchor of data. They wait for the current to subside, then skillfully navigate to pluck treasures from the riverbed, assets overlooked or discarded by the panicked masses. This is how we challenge the consensus and find our edge when others are lost to the tide. Many of us hold on to certain anchors in the financial storm, traditional safe havens like bonds or gold, with a quiet, unconscious trust. We anchor to their past performance, expecting them to shield us, only to find their fundamental drivers have shifted. This can lead to a profound disappointment, a false sense of security that, when shattered, leaves unexpected losses and a feeling of being betrayed by what we believed was steadfast. Is your diversified portfolio truly diversified, or are you holding onto a myth? There's a common distortion that defensive assets inherently act as a hedge, a universal shield against all market downturns. But this assumption often bypasses the rigorous analysis required. We must ask, what is their current valuation? How sensitive are they to interest rate changes? What is their actual correlation with equities during this specific downturn, not just historical averages? The data reveals a counterintuitive truth. In certain bear market scenarios, particularly liquidity crises or periods of rapidly rising interest rates, some safe assets can paradoxically transform into risk assets, exposing systemic vulnerabilities overlooked by mainstream analysis. This calls for a practical transformation in our approach. Instead of generic diversification, which often just means owning many things without understanding their true risk contribution, we can embrace a risk parity framework. This allocates not merely by capital, but by the actual risk each asset brings to the portfolio. It demands rigorously stress testing asset correlations and volatility across various market downturn scenarios. scenarios, building a resilient structure rather than a merely broad one. It's about understanding the why behind every decision, especially concerning protection. Consider the market as a complex, living ecosystem. Relying on one safe species to guard against all predators is a naive hope. The data-driven investor, however, understands these intricate interdependencies. They diversify not just by species, but by function, by how each component truly behaves under different environmental stresses. This ensures a deeper, more profound resilience against unforeseen threats, allowing us to navigate the wilderness with informed precision. Navigating a bear market can exact a profound emotional toll, leaving one feeling like a mere follower, swept along by forces beyond control. This erosion of financial confidence, this feeling of being outmaneuvered by irrationality, can deeply wound our decision-making autonomy. It's a primal fear that the ground beneath us is dissolving, making it incredibly difficult to critically analyze data when stress levels are high. Our minds, under pressure, often fall prey to loss aversion, where the pain of a loss feels twice as strong as the pleasure of an equal gain, driving us to sell at the very bottom. Simultaneously, confirmation bias leads us to seek out only information that validates our existing fears, solidifying a narrative of despair and preventing rational re-entry. Many hold the shattered expectation that investment success is purely about market knowledge. Yet, the profound impact of unconscious cognitive biases like herd mentality and the availability heuristic often proves to be the true determinant of underperformance during crises. We see others panic and feel an overwhelming urge to join them, or we dwell on the most recent, vivid losses, allowing them to dictate our entire outlook. These are not failures of intellect, but deeply ingrained patterns of thought. Daniel Kahneman, in his seminal work Thinking, Fast and Slow *, illuminated the stark difference between our impulsive system 1 and our deliberate system to thinking. To immunize your portfolio against panic and FOMO, we must develop a system to checklist for bear market decisions. This means consciously pausing those impulsive system 1 reactions, the gut feelings screaming to sell or to chase. It involves pre-committing to data-driven actions, such as predefined rebalancing triggers, setting them when our emotional signals are weakest so they can guide us when our emotions are strongest. This disciplined approach builds in inner resilience, a solid framework for decision-making. Your mind is the ultimate battleground in a bear market. Without a strong behavioral moat, a fortress built of disciplined logic and predefined rules, the relentless tides of fear and greed will inevitably breach your defenses. This leaves your wealth vulnerable to the erratic shifts of emotional tides, rather than anchored by the steady hand of informed reason. We're uncovering the hidden truths behind wealth accumulation, starting with the truths within ourselves. We have journeyed through the unsettling mists of bear markets, not to be swept away by fear, but to uncover the hidden strategies that transform uncertainty into profound opportunity. We explored the tactical shift, understanding when buy and hold becomes a liability, not a virtue, and how to dynamically reallocate. We embraced the liquidity paradox, recognizing cash as dry powder, a strategic advantage for acquiring value when others are forced to sell. Our contrarian compass guided us through panic, helping us discern deep value amidst market noise. And finally, we built a behavioral moat, immunizing our portfolios against the powerful tides of panic and FOMO, understanding that the greatest battle is often within. This journey reaffirms the immense power of a data-driven, critical mindset. It is not about chasing fleeting trends or succumbing to the market's emotional whims. It is about fostering true financial mastery, empowering independent decision-making rooted in rigorous analysis, rather than relying on the fickle currents of market sentiment. This approach allows us to connect complex financial theory to practical, profitable, and ethically sound investment application, distinguishing genuine mechanisms from market noise. Now, the invitation is to cultivate a resilient portfolio culture within yourself, one rooted in analytical rigor and emotional discipline, preparing not just for mere survival, but for strategic advantage in the next market cycle. This is the path to sustainable wealth accumulation, built on the bedrock of informed choice and inner fortitude. It's about more than just numbers. It's about the quiet strength that comes from understanding, from seeing clearly when others are blinded by fear. As Warren Buffett wisely observed, only when the tide goes out do you discover who's been swimming naked. A bear market, in its raw honesty, exposes weakness, reveals the vulnerabilities in assumptions and strategies. But for the prepared, for those who have dared to look beyond the headlines and truly understand the why behind every decision, it reveals the clear path to enduring strength and profound wealth creation. What hidden truths will you uncover in the next market tide?